Hey, welcome back to our YouTube channel here where we interview our preferred partners in the area that give you the local competitive advantage. Today, we've got a great interview. We're with Val. Val is with Parallel Financial, has helped a lot of my clients out with budgeting and helping you grow that wealth. One of the things that we do on our side is we get you that mortgage, but we help put you in debt, right? And when we've put you in debt by, let's say, $500,000, we're helping you play defense. Val's on the other side. She helps you play offense. She helps you build that financial wealth. So you're not just struggling paycheck to paycheck and how are we going to put those payments together? So I thought, you know what, Val, let's chat here. Let's kind of talk about what are some of those strategies that you use. So for those first time home buyers, any home buyers, they've maybe
Yeah.
just taken out all of their assets. Maybe just, they got a payment that's bigger than anything they've ever had before in their life. Let's talk.
Yes,
What are we doing? How can we help them play offense?
absolutely. And I love the fact that you're talking about we just put them in a big chunk of debt. So how
Mhm.
can we work our way out of this and make strategies that make sense for us? So the first piece that we're doing, ideally before the purchase of the home, but not always, is looking at the big picture. So we want to see, okay, what is our income going to look like? What is that mortgage payment going to be? What are those other bills that are now coming with the mortgage? So whether it's property taxes, if those aren't built into the mortgage payment, what utilities will we have? And then we look at typically the last full month. So we're going to look at, okay, what did we spend on groceries? Because that likely won't change, especially if they were potentially living together before. So we
Right.
look at groceries, but if they're moving out of potentially mom and dad's, where mom and dad pay for groceries, we're going to put a number to that and hope it's kind of close. But we always budget up. So plan for too
Right.
much, ideally, surprise ourselves with less. And then we're going through things that are, fuel, transportation costs, and looking at then that kind of other column, which can have a lot of things in it. And looking kind of working backwards to give that column a number because that typically is our most unmonitored column. That's what I'm gonna say. So
Right.
whether it's eating out, miscellaneous online shopping, Amazon. Amazon's a big
Yeah,
one.
yeah. Yeah, and how and what percentage of times, like when you're meeting with people and you're talking to them,
Yep.
how often do you find some savings in there where you're like, wow, I didn't know I spent that much money on Amazon. I didn't know I had that many subscriptions. I didn't know I had that many, whatever
Yep.
it might be. I assume how many people, is there maybe a percentage? How many of those people come
I
across
would
that?
I'm gonna say 99% of the time we haven't looked at our numbers until we meet, or they haven't looked at their numbers until we meet. And 99% of the time there's something on there that they're like, I don't need that. I can cancel that. Or if it's two people coming together, they're both paying for the same service. They don't both need it.
Right. Or in a
99%
lot of cases, I
of the
imagine
time.
those subscriptions have gone up. Hey, I thought I was paying $9.99 for Netflix. I didn't realize it was twenty seven
Yes.
ninety nine now. Right.
Yes. Like putting those numbers in front of us. And I'm always very clear to say this is a science experiment. This is not to sit here and judge you and belittle you and
Mhm.
berate you about what you did last month. This is strictly we are just scientists observing what Adam spent his money on last month. That's it. And we can't go back in time. We can only go forward. So we're just looking at this. These are the facts. That's it. We're not doing this because I don't want someone to take on more shame in those meetings. I want them to take on, okay, in enlightenment, we're taking the blinders off. We're looking at the statement. We're seeing what's going on because we have to have that foundation, especially now that we have this mortgage payment. Because if we want to keep that asset, we've got to start taking care of our dollars.
So we've gone through this budgeting, and maybe let's say we found something as little as $50 a week that we can save. How fast
Yeah.
does that add up?
Well, we want to like over time, it
Yeah.
surprises people by how fast it's just something small, right? And we want
Mhm.
to also talk about the things that, okay, we have this money. What in the next year is happening? Does the new house need an AC? Does it need a roof? Or are all of
Mhm.
those kind of larger expenses taken care of? And can we put this to something that's more long term for us, right? So protecting with that emergency savings or safety savings, whatever you want to call it, and then looking at longer term. Because if you put in, I could run a quick calculation. The younger you are, and you start saving for things like retirement, which I was talking to a grade 7 class in Simcoe, and I said, this is not even on your radar. But if you start at even 20, it's going to be so much easier for you to actually retire than it
Yes.
is if you start planning at, age 40, age 50.
Right,
So the
right. You know what?
50,
And it's funny. Like I spent a lot of years in the bank, right? I was 17 years at the
yes,
bank, and I think about a conversation I had with a regional vice president, and one of the comments that he made is, if all areas of the bank would work together, we could help our clients so much more. And what he talked about there was, the financial advisors, they only worry about the assets. The mortgage guys, they only worry about the
yes,
mortgages. They've got the entry level FSRs that are only there for a couple months maybe, and then they're gone. And he says, but if
yep,
we would all ever work together, we could do so much for our clients, so much for our bank, and so much for everybody. But they really all kind of work in silos. And that's, I think that's all banks in a lot of places. And I think this
yep,
is where we can work together. And that was one of my goals when I came on and I was going to start my own thing. And that's why we work with you. That's why we have accountants. We have, insurance, life insurance, property insurance. We've got everybody that we work with together. And I love this that, we've got that mortgage. We're playing defense. You're playing offense. They start
yeah,
saving that $50 a month. They've got a retirement savings. You want to buy that next house. You want to protect that insurance, the air conditioner, if something happens there, the roof, maybe we
absolutely.
need a roof. Like there's a lot of different things for, especially those first time home buyers that they don't expect. And when we can save a little bit of money every month, like you said, it adds up quickly.
Yes. And I love that bank previous coworker recognized the harmony that can come from working together and looking at those numbers as a team versus just handling your section and then passing it off. Because if we can look at it as a whole, for the client,
Mhm.
it's so much better.
Absolutely.
Yeah. So tell me
Yeah.
about we're speaking about budgeting, and you had mentioned before we hopped on, it's a bit of a myth that financial planners won't help their clients or won't help you because you don't have enough assets. So
Right.
you're coming across this as feedback from clients,
Yes. Yes. Yeah,
and
no, we see it all the time, right? I don't have enough money, right? Like I
yep,
can't meet with a financial planner. I don't have $50,000. I just took my $50,000 and bought a
yeah,
house. I just put whatever it might be, right? Why would a financial planner want to talk to me, right? And that's where I love about you. Like, let's build that budget and let's start regrowing that nest egg, right? Especially
yes,
for those first time home buyers that, the myth is out there that, hey, they can't even buy a house. So, now they've bought that house. What do we do? Maybe they pulled that money out of a RSP, first time home buyers plan.
yeah.
What now, right?
Absolutely. And when it comes to that myth, there are certain financial planners that will not work with you unless you have a certain amount of assets. But I have a different avenue where, yes, we might do life insurance, we might do investing, but there's a different avenue, and it's more financial coaching, which is looking at that budget. It is starting those savings, right? Making sure that our money's doing the right thing and we know what our money's doing. So there's that piece to it that there is someone out there that will help you. You don't have to wait until you have a certain amount saved up. Like financial literacy should not have an entry fee.
Right, right. No, that's really important, and I love that you do that for your clients and for all of our clients, so where we can work together. So, yes, I appreciate that.
Yes. Well, thank you. And I have been meeting with clients and hearing this in my work and also just in personal conversations of I'm never going to own a home. I'm never going to own a home. So what's the point? Why should I even bother saving? And then the whole kind of consumer spending takes over because there's well, I'm never going to own a home. So what's the point in putting money away? Tell me about the success you've had with first time home buyers and that it's not this far off in La La Land dream. Like this is attainable. And what traits have you seen in those first time home buyers?
Yeah, so the number one thing that we see in first time home buyers, and we do, and I'll tell you, like I've worked with a lot of first time home buyers this year. There are a lot of them out buying their first
Yeah.
homes, so the myth isn't there. I'll tell you the biggest thing that we don't see in these first time home buyers, and this is probably the biggest one, is we don't see car loans, right?
Ah,
Car loans are the biggest killer
yes.
of first time home buyers. If there's different numbers, you have that five, six, $700 a month car loan, you're
Yep.
costing yourself $100,000 to $150,000 off of that pre-approval. And when we're looking at the housing market and what it's doing, if you're costing yourself 100, if you're going from 450 down to 300, you're out of the market. You're gone. You're
Yep.
you're you're not buying that property, right? And so the first time home buyers, what is the biggest thing we see with first time home buyers? They don't have car loans.
That is so fascinating and makes so much sense because I've met with clients and they had a truck loan, a quad loan, and it was for them it just took getting rid of the quad, right? It was
Yes.
say goodbye to the toy and you can say hello
Hmm.
to a home, but some of these
Right.
truck loans are outrageous, especially in our area.
Everybody
The
wants a brand new truck, right?
everyone,
And
yes.
everybody loves a brand new truck, and
Yep.
even a brand new car, right? It's not. I think back to the very first car I bought. My payments. I remember $99 biweekly was what we paid. 99 was the
Yep.
promotion that we had on at that time. We're going back. We're dating ourselves a little bit, but those days are long gone. You're not getting a $99 a week payment, let alone
No.
biweekly payment, right?
No.
Those payments are through the roof. And then unfortunately, what a lot of people are doing is, hey, here's your payment. In 2 years they're going to call you back. Hey, do you want to upgrade? Do you want a brand new car? And all of a
Yes.
sudden we're into another car loan and we're upside down on those, and we're behind on that car payment. Not behind on your car payment, but you owe more than your car's worth. Right. And
Yes.
we see those all the time. And it's the worst thing that these guys can get into. And
Yep.
you want to talk about, I'll never own a home. If you own a brand new car, you might be right. Right. But if you go and you sacrifice and you buy, that little bit, the car that's a little bit older and a little bit, not brand
Yeah.
new, doesn't have all the bells and whistles on it. Yeah,
Yep.
you can buy a house, and that house is going to go up in value where your car is going to only go down in value. And guess what? In
Yes.
4, 5, 7, 10 years, when you've got that equity in your property, now you can buy that brand new car, because now you're probably into your second, level. You're not in that, entry level job. Now you've moved up in your job. You're making a little bit of higher income. That's when you want to look at those cars. But yeah, for first time home buyers, absolutely they can save up. And there is a lot of scenarios where we are seeing some of the parents, gift those down payments. We're seeing
Yep.
some different scenarios there where you're getting that gifted down payment. Sometimes we're having parents take out, or even grandparents take out reverse mortgages on their property. They've got all kinds of equity. They've grown in equity like crazy
Yeah.
on their property. And we're actually doing some reverse mortgages where, hey, it's not going to cost the grandparents anything. The money was probably going to the grandkids or the kids anyways. Why not let the grandparents see, the kids have that, enjoy their house, right?
Yes.
And so once we kind of walk through some of those, and reverse mortgages aren't as scary as they used to be, right? They're not a scenario where we're going to
No.
throw you out on the street. There's a lot of equity that are in these places now. So they're not as scary a thing, right? So we are getting some help there from some of the parents with those down payments, and letting the kids actually see, the parents and grandparents actually see their kids enjoy that money that they've worked so hard for.
And that's the value of working with an expert such as yourself is understanding that there are creative solutions. And by, accessing these creative solutions, we don't like it doesn't have to mean that you're not going to be able to afford that monthly payment because there are some creative solutions that I've come across and the client can't sustain them. Not from you, but
Right.
the client can't
Right.
sustain them. And those are tough because then we've just kind of kicked the can down the road and they're probably going to have to sell their house next year anyways. But this situation is yes, creating that generational wealth transfer sooner and getting them into a home and then grandma and grandpa or mom and dad are able to see them enjoying that. That's not everyone's situation. And you don't need to have that to make that your situation, but it's talking to experts. Instead of just saying it's not possible for me, talk to myself, like talk to Adam, ask the questions and
Mhm.
understand what that looks like.
And you talk about that wealth transfer. One of the benefits in a lot of situations where we're using that reverse mortgage and giving that gift as down payment,
Hmm.
you talk about wealth transfer. There's a lot better tax implications, on most situations
Hmm.
on doing it that way versus waiting for probate and waiting for that to go through, probate and all those, estate
Yes,
taxes that might
estate
come on too.
planning
So,
is becoming more and more
mhm.
important. So yes, and I want to go back to the car piece first. I think there's a big with typical first time home buyer ages right now or that demographic, there is a big stigma around not having a car maybe that's as flashy or has those bells and whistles or is old like older. But what's more important, right? So on that priority shelf, is the fancy car more important, or can we sacrifice that, have a car that's not so fantastic, but it works, and
Mhm.
be able to save for that home? Priorities. Yes. Yes, that's a big one
Absolutely.
right now.
Absolutely.
The piece that
Absolutely.
I wanted to ask you about, so jumping from the first time home buyers to current homeowners. So I have some clients,
Hmm.
they have mortgages that are from 2021, 2020, and they saw last year, they saw the wave go up.
Yes.
They're locked in, so they're happy, But that chapter is coming to an end, so they're a little
Yes,
nervous. What's going to happen? My rate's going from 1.9 or 2% up to unknown, but it's not
more than
2%
double.
anymore.
Yeah,
Yes.
yes,
So
yes.
what does that look like for them? What are you seeing right now? What are some strategies that you're working with your refinance clients?
Yeah. So for starters, when we're doubling an interest rate, it doesn't mean doubling a payment, right? We
Right.
have a lot of clients that we're hearing, my interest rate's going to double, my payment's going to double. I don't know what I'm going to do.
Yeah.
Right. And it's a legitimate concern that we have. And it's not going to double. It is going to go up, but it's not going to double. So there's different numbers. The average, if your interest rate's going up, from that 2 or 3% up to 4 or 5%, you're probably going up 15. Your payment's going to go up 15 to 20%. That doesn't feel good. A 15 to 20% increase on your mortgage payment
Right.
doesn't feel good, but it feels better than doubling it. So
Yeah.
there's a lot of surprises in there. And what is the bank going to do? The bank's going to call you and say, hey, come and do it early. We're going to save you some money. And it's really one of the worst strategies that you can do, because really what they're doing is they want to buy you out of that percentage of time. They'll say, hey, you can do it
Mm,
6 months early and we'll give you a blended rate. Well, I worked in the bank. The blended rate is really just, you're going to continue with this rate for this little bit of time and you're going to get the higher rate for the rest of the time. That's all they're doing when they say we're going to give you a blended rate. They're not really saving you any money. When you actually run the numbers, they're giving you the exact same rate of what you had. And they're going to send you a letter, right? The other option, if they don't want to do that, they're just going to send you a letter, say, hey, please sign, because they
mhm.
know that there's a certain percentage of people that are just going to sign and just be happy that they don't have to do it. So
Yes.
when it
Okay.
comes time to that renewal or refinance piece, let's sit down, let's review exactly everything that you have going on. It's such a
Yep.
perfect time to maybe a reset button that we need to press. And, is there some other options out there? And we are seeing some that right now, yes, I have, I'm down to 20 years on my mortgage. I'm down to 15 years on my mortgage, but I'm
Yes.
struggling with payments. And because I'm making those payments and they're going to be going up, I have credit cards that are going up. I have lines of credit that are going up. I'm
Yep.
sacrificing my savings. I'm not contributing to my RSPs anymore because of these other things that are going
Yes.
on. And in a lot of cases, what we're looking at right now is what's a right now solution, right?
Yep.
What's maybe stretching that mortgage back out over 25 years? Instead of that 15 amortization, go back to 25, go to 30 years sometimes,
Mhm.
and let's come up with a right now solution. And let's work with a lender that's not going to lock us in. So we're not working with an ultra low rate lender that gives us you see them online. Hey, we got a 6 month 3.99. Well,
Right.
that's a 6 months at one rate, and then the rest is at a higher rate,
Yep.
right? So we're not working with those lenders. We're working with somebody that lets you allow you to, maybe double up your payments, maybe add an extra 10 or 15 or 20% of your original amount borrowed. So we can get through some of the tough times that we're in right now.
Yeah.
And then down the road, you can increase those payments. And that's where we work together, and come up with those strategies of how are we going to save you money, not just today, but long term. So that payment shock, you're not pulling the kids out of sports, you're not pulling the kids out of school events. There's a lot of those things that, maybe I'm on the back end of it right now because I've got kids that are going away to college. My kid's going away to college next year. And you kind of see those, but you only have your kids for a certain amount of time. The last thing you
Yes.
want to be doing is sacrificing and pulling them out of, some of those extracurricular activities that they love to do just to make the mortgage payment. Right. So that's where let's look at some of those strategies and what are some right now strategies and how can we mend those with forever strategies.
I love that. And I think to your point, instead of just taking the rate that the bank gives you or signing that paper and sending it back, having a conversation with someone who wants to see your full picture because you sign that and you send it back, but your car is that car that you sacrificed for and it's on its last legs. Within the next 2 years, if you need to be purchasing a vehicle, do we take that equity out now, have it in our hands,
Hmm.
toss it in a TFSA, grow it in a high interest option? In into the weeds, but the purpose being get the money out now and have it ready for that purchase instead of financing a car at 8% or 7%.
Absolutely.
Yes.
Absolutely. No, there's so many options. And there are some people that we look at and we say, hey, here's, our rate's only 10 basis points lower than the bank's rate. We're going to have to go through a new application process. Maybe just take my rate back to the bank and shop it back to them and see if they'll match it. Right.
Yep.
And then sometimes that is the best case scenario, but sometimes it is, let's renew it. Let's refinance it. Let's look at
Yes.
accumulating some of the other debt and stretching that payment back out over a longer period of
Yeah.
time. And in a lot of cases, that's really what's winning and helping our clients.
Love it. And to your point, it's not that they have to work with you because if the right choice is the bank, you'll happily guide them to do that. But if it makes sense, you're going to do what makes sense, which is so important.
Absolutely.
Yes.
Absolutely. Like I said, I was 17 years in the bank. Most of them are gone now because the bankers
The
don't
bank.
stay there very
Yeah.
long.
Yeah.
But
Because
like I said, we can send you back to different banks at. So no,
awesome.
absolutely, we can help you out. We were, like I said, we work together. We come up with the plans to make sure that our clients are successful, not just today but long term. So
Absolutely. Looking,
we're hitting that 20-minute mark, which is kind of where we want to be around. I don't want to keep you too
that's
long. I really
perfect.
do appreciate you joining here today, Val.
Yeah.